Level 1. The Watcher. It's March 2022. The Nasdaq dropped 4% today. Yesterday it dropped 3%. Last week another 2.8%. And you're sitting in front of your computer with $47,000 in a cash account earning almost nothing, watching all of it happen. And you know what the feeling is? It's not anxiety. It's pleasure. There's something very specific that happens when the market is falling and you're sitting in cash. A voice inside you that says, I knew it. That says, I protected myself. That says, while everyone else is losing, I'm whole. And that feeling is real. It's genuine. The problem is that it's also the most dangerous thing that can happen to you at that moment because it makes you confuse luck with strategy, timing with intelligence, and caution with vision. You didn't sell because you predicted the crash. You sold because you were scared, or because the market had already run up too much in your head, or because you read something that made you uncomfortable. But now that the market is falling, the story changed. Now you knew. And that's exactly where the cash starts destroying you in a way you don't even notice. Because cash in a crash is not a neutral position. It's an active decision. Every single day you hold that money and do nothing, you're betting the market goes lower. You're effectively short. Without realizing it, without admitting it, but you are. And the market doesn't care about your narrative. By March 2022, the S&P 500 had fallen roughly 13% from its January peak. It felt like a lot. It felt like the beginning of something bigger. And it was, in a way, because by October 2022, the market dropped another 20% from there. But whoever was sitting in cash in March thinking they'd buy when it gets clearer, waited until October. And in October, the feeling wasn't opportunity. It was panic. It was, it's going lower. It was the same voice, just from the other side. That's what cash does to you in a crash. It doesn't give you clarity. It gives you comfort. And comfort and clarity are completely different things. Level 2. The freeze. 3 weeks have passed. The S&P is down 19% from its peak. CNBC has a new crash graphic every morning. Your Twitter feed is nothing but people calling for another 2008. And your $47,000 is still sitting there, untouched. You told yourself you'd buy at 15% down. Then 15% came and you said 20%. Now you're close to 20% and you're thinking maybe 25% is the real bottom. And the crazy part is that this isn't weakness. This isn't stupidity. This is actually what happens to the people who study the most. Because you know, the more scenarios you can build. The more data you've read, the more comparisons you can make. You remember that in 2008 the market dropped 57% peak to trough. You remember that in 2000 it took 2.5 years to find the bottom. You remember that catching a falling knife is one of the most repeated warnings in investing. And every single piece of knowledge you have becomes a reason to wait one more day. That's the trap nobody talks about. Analysis doesn't remove fear. It dresses fear in a suit and gives it a Bloomberg terminal. And while you're building spreadsheets and reading macro reports, something else is happening. The cash in your account is not neutral. Inflation in 2022 was running at 8.5%. Your $47,000 in January became $47,000 in name only by June. In real terms, you lost roughly $2,000 without touching a single asset. The crash was happening to you too, just slower, just quieter, just in a way that didn't show up on a chart you were watching. There's a very specific psychological mechanism behind this freeze, and it has a name. It's called loss aversion, and what most people get wrong about it is the direction. Everyone thinks loss aversion means you're afraid of losing money in the market. But in this moment, the loss you're afraid of is buying too early and watching it drop further. The pain of being wrong is bigger than the pain of missing the move. And you wait. And the market doesn't care that you're waiting. The investors who actually deployed capital during the 2022 drawdown and held through 2023 saw the S&P recover over 24% in a single year. Not because they timed it perfectly, because they moved when it was still uncomfortable, when the headlines were still bad, when every indicator was still flashing red. Comfort is not a strategy. It never was. Level 3, the entry. You finally do it. It's June 2022. The S&P is down 23% from its January high, and you decide this is enough. You buy $15,000 worth of a broad index fund. It feels good for about 4 days. Then it drops another 8%. And now you're facing something nobody prepared you for, not the loss itself. The loss is manageable. What you're not prepared for is the silence, the complete absence of any signal telling you whether you made the right call or the worst decision of your life. You bought, it went down. That's all you have. This is the moment that separates almost everyone. Because right here, two things happen simultaneously. The rational part of your brain knows that if you believed in the thesis at minus 23%, you should believe in it even more at minus 31%. The math is cleaner. The entry is better. But the emotional part of your brain is doing something completely different. It's collecting evidence. Every red day is proof you were wrong. Every negative headline is confirmation that it's going lower. Your brain is no longer analyzing the market. It's building a case against your own decision. So what do most people do? They wait again. They have $32,000 left in cash and they don't touch it. They tell themselves they'll buy more when it stabilizes. And stabilizes never comes with a flag and a bell. It comes quietly, in the middle of bad news when nothing feels safe. Look at what actually happened in every major crash in modern history. In 1987, the market dropped 34% in 2 months and recovered everything within 2 years. In 2001, the bottom came in October after 2 years of pain, right when the consensus was that tech was permanently broken. In 2008, the exact bottom was March 9, 2009. The same week, a major magazine ran a cover story about the death of equities. In 2020, the crash was 34% in 33 days, and the recovery started March 23rd, the same day the Fed announced unlimited quantitative easing, which almost nobody caught in real time. The pattern is always the same. The bottom never feels like the bottom. It feels like the middle. It feels like there's more pain coming, and statistically, the best days in the market are almost always clustered right around the worst days. If you missed the 10 best days of the S&P 500 between 2002 and 2022, your total return dropped from 641% to 191%. 10 days, out of roughly 5,000 trading days. And those 10 days happen when everything felt the most broken. You can't time that. Nobody can. Not consistently. Not in real life, outside of a backtest. What you can do is be in the market when those days happen. And the only way to be in the market on those days is to have already bought before them. When it still hurt. When the news was still terrible. When your gut was still telling you to wait. Your gut is not a market indicator. Level 4. The asymmetry. The market is still down. It's September 2022. And while you've been watching charts and reading Fed statements and debating on Reddit whether this is a soft landing or a full recession, something completely different was happening somewhere else. Something that never made it to your feed. In January 2022, Blackstone's real estate fund Bright had $69 billion in assets. When the market started crashing, retail investors panicked and started requesting redemptions. Blackstone limited withdrawals to 2% of net assets per month. They controlled the exit. They decided the terms. And while everyone was selling, Blackstone was selectively buying distressed assets at prices that hadn't been available since 2009. They didn't panic. They didn't freeze. They deployed $9.4 billion in new investments during 2022 alone. You didn't have that option, not because you weren't smart enough, because you didn't have the structure. This is the part of the crash nobody explains to retail investors, and it's the most important part. The people who actually make generational returns during crashes are not the people who had the most cash. They're the people who had cash plus access plus credit, plus relationships that existed before the panic started. Warren Buffett didn't make his best deals because he predicted crashes. He made them because he had a phone that people answered when everything was on fire. In 2008, he called Goldman Sachs and got a deal that paid Berkshire $500 million a year in preferred dividends plus warrants. That call was not available to you. Not because of money, because of position. In 2020, when the crash happened in March, private equity firms with pre-arranged credit lines deployed capital within days. They had agreements signed in 2019 that allowed them to draw billions at predetermined rates the moment opportunities appeared. They weren't smarter than you during the crash. They were prepared before it. And here's what that actually means in practical terms. During the 2022 drawdown, the average retail investor with cash sat on the sidelines for 4 to 6 months before deploying meaningfully. The average institutional investor with dry powder and credit facilities was deploying within 3 to 6 weeks. That gap, those 3 to 5 months of hesitation, is where returns are made or missed, because the assets that were available in April 2022 were not available in August 2022 at the same price. Liquidity without access is just numbers in an account. And access doesn't come from having cash during a crash. It comes from building relationships, credit history, and institutional trust during the years when nothing is crashing. The people who won in 2022 started preparing in 2019. The people who won in 2009 started preparing in 2006. Not by predicting the crash, by building the infrastructure to act when everyone else was frozen. Your $47,000 was real money. It was discipline. It represented real sacrifice. But in the architecture of a crash, it was rowboat in a regatta of yachts. And the difference wasn't luck. It was time horizon and preparation. That's uncomfortable to hear, but it's the actual game. Level 5, the loop. It's January 2024. The S&P 500 closed the year up 24.2%. Your portfolio recovered. If you deployed that $47,000 across 2022, even imperfectly, even with bad timing, even buying 3 months too early, you're sitting on real gains. Not life-changing, but real. And you feel something you didn't expect to feel. Not pride, relief. Because pride would mean you understood what happened. Relief means you survived something you didn't fully control. And deep down, in the part of you that's honest with yourself at 11 p.m. when you're not performing for anyone, you know the difference. You didn't crack the code. You endured it. And now the market is making new all-time highs. The same people who were calling for a depression in October 2022 are now talking about AI supercycles and soft landings. The narrative flipped completely, and it flipped fast, the way it always does, the way it always will, because the market doesn't move on reality. It moves on the collective story people tell about reality. And that story changes faster than any spreadsheet can track. So here's what actually happened to your $47,000 across those 2 years. You held cash while it lost purchasing power. You froze when you should have moved. You moved when it still felt wrong. You watched it drop further and almost sold. You held. It recovered. You learned something. But you're not sure exactly what. And that uncertainty is the most honest place you've ever been with money. Because the lesson is not buy the dip. Everyone says buy the dip. The lesson is that having cash in a crash is a test of something that has nothing to do with finance. It's a test of your relationship with uncertainty, with being wrong publicly, with acting when every signal says, wait. And most people fail that test not because they're irrational, but because they're human. Completely, unavoidably human. The investors who consistently deploy during crashes are not less emotional than you. They've just built systems that remove the decision from the moment of maximum fear. Automated investments, pre-written rules, predetermined allocations. They decided what they would do before the crash happened, so they didn't have to decide during it. That's the actual edge. Not intelligence, not prediction. Preparation before the panic. And right now, somewhere, there's a 24-year-old opening a brokerage account for the first time. The market is near all-time highs. Everything feels stable. The headlines are optimistic. And they're reading about dollar-cost averaging and long-term investing, and they're feeling what you felt in 2020 before everything dropped 34% in 33 days. That specific kind of confidence that only exists before you've been truly tested. The next crash will come. It always does. Not because markets are broken, because markets are human. And humans cycle through the same emotions with extraordinary precision. Fear, denial, panic, capitulation, relief, optimism, euphoria. Then fear again. Your $47,000 sat in cash while the world felt like it was ending. And the world didn't end. It never does. It just reorganizes who owns what. And the game continues, with new players, with the same rules, with the same silence at the bottom, the same noise at the top, and the same voice inside someone's head saying, "I knew it," while the market falls and their cash sits untouched, and the whole thing starts over again.